This is the Cash Value Solutions Podcast, where your hosts, Jason Pohlmeyer and Kyle Manns, shed light on little-known money truths to help you take control of your financial future and become your own banker. Subscribe, rate, and review the show, and check us out at cashvaluesolutions.com.
Hey, everyone. Welcome back to the podcast this week. What are we going to be talking about, Kyle?
So we're back in the book review this week, and we're going over the equipment financing, which is part 4 in Nelson's book. Yeah, this is in depth, and it's long.
Numbers.
Yeah, and they can be confusing for people. They confused me when I first read it. So
definitely.
Hopefully we can prevent that.
Yeah. Our goal here is we're not going to go through every illustration, guys, but we are going to go through illustration 1 and illustration 2. We're going to explain pretty much exactly what is going on in these things, and you can take it and run from there on the rest of them.
Yep.
But it's really just a lot of similar things happening in the next ones, so we don't want to bore you by just going over numbers in a podcast format while you're driving down the road.
So let's first start this review off with just going over the couple pages before the illustrations with some of the conceptual talk that's in here.
Yeah, Nelson has led us up to this point, okay? Remember, everything we were talking about was conceptual. We were talking about being honest with ourselves, not stealing from ourselves and everything in the beginning of this book. So Nelson's reiterating, you have to understand that before this happens. It's why we tell people you cannot skip to the illustrations in the books. That isn't what this is about. You need a solid, firm footing to stand on to understand what's going on here.
Yeah, exactly.
And not to, I don't mean that as to understand the whole life insurance. I mean to understand why becoming your own banker makes sense.
Yeah, the process is much more important than the product.
Exactly. Okay, so Nelson says, you may find it necessary to accumulate capital over a longer period of time than what he's depicting here. Now, additional capital is going to make the system more profitable. Why is that? One, the insurance company is growing your money for you, okay? Remember that. And two, the more money you have in the bank, the more things that you have the ability to go and finance. You have more opportunities in front of you.
The bank is in your private bank in the policy.
Exactly. Yep. Okay. And now here's something that people will complain about in today's society. They want to buy term life insurance and get it as cheap as they possibly can, okay?
Yep.
So anytime we think of paying more premium, we're upset. I don't want to do that. But in this case, this is completely different than your home insurance or your health insurance.
Car insurance.
Or your auto insurance, yeah. Those premiums go to the the insurance company, but you don't see them anymore. You don't have access to that money, okay? If we pay more premiums into a life insurance policy, that's going to directly affect how much money that we have access to, because you have access to the cash value of a life insurance policy.
Yeah, how you fund
permanent
the policy.
Life insurance policy.
Yes, permanent life insurance. How you fund the policy is more important than anything that the insurance company can do investment-wise.
Absolutely. More important than any rider you put on the policy, anything. Your behavior, your willingness to pay premium, that's the number one thing that you can do to affect your policy. The number one thing you can do.
Absolutely.
Okay. And Nelson goes on to say even further, now, there are no licenses required, no customers to seek out. This business is already there. All you have to do is tap into it, okay? Mm-hmm. All you need to do is start your own life insurance policy. This isn't like a seed business where you have to go out and find customers to sell seed to profit from, okay? The system is there already. All you have to do is start and pay premium, capitalize your system, and in a very simple way, that's all you have to do.
Yeah.
Everything else is going to take care of itself.
And that isn't free. You can't just tap into a system for free. And that's why at the beginning, we have to pay those insurance costs up front.
Absolutely. It costs money to start any business that you get into.
Yeah, but the difference of starting this business is you are guaranteed to get your money back at some point.
And you have high liquidity immediately
Yeah.
in the business.
Exactly. I mean, you can lock your money away in your 401k, and who cares at what interest rate it's growing at? If you're 25, you aren't going to see that for what, another
35 years.
Yeah, 35 years.
Yeah.
So
it comes down to accessibility. This system is highly accessible and guaranteed.
Yep.
Okay. So anything you want to add before we jump into illustration 1, Kyle?
Nelson goes in here to say that it's important that you must understand as a policyholder that you outrank all possible borrowers to the access of that capital the life insurance has.
And why does it matter that we understand that?
Because that gives us complete control. That's where we get the complete control from, is because we are number one in line to access to that.
Yes. And we should also make it clear that you don't have to borrow from these policies to make this work. That is, people will go to this section and think, my goodness, like borrowing from these policies really makes them start to perform really good. Okay. We're going to explain that here, but that is not what's making this happen. There's just more premium going into these policies. The insurance company is putting that money to work, and if you want to borrow it, you have the right to borrow it.
Yeah. And another thing that he goes into here is talks about how most business owners and people they build equity in the wrong places. They build equity in their, for example, the equipment that they're buying. They're dumping all of their cash into this equipment instead of building it in a banking policy first.
Right, and your accountant will say, look at all the equity you're building in that, look at all the tax write-offs and everything we're getting, right?
Yeah.
But we're focusing on the wrong thing in this instance. We're focusing on the equipment instead of our own banking business.
And that equipment is also going to depreciate.
Right. Now, we're not saying that the equipment isn't important because you need it to make your living, but just realize that there's more going on than what you see sometimes. And Nelson, this is one of my favorite quotes from this book. Everyone should be in 2 businesses, the one in which you make your living, and the other should be the banking business that finances whatever you do for a living. Of the 2 businesses, banking is the most important. Okay, why is that? Because banking is always going to happen no matter what.
Yes.
No matter what, banking is always going to happen.
And if you're looking at a policy, one of the last things you should think about is, well, how long do I have to pay into this? Well, how long do you need access to money? Like Nelson says in here, he said businesses come and go, but banking is eternal.
Absolutely. Anytime you have cash flow, and I mean, not talking about just minuscule amounts, but anytime you just have some extra cash flow, money sitting somewhere, you're going to accumulate it somewhere, right, Kyle?
Yep.
Okay. If you're creating your own banking system, you want to accumulate it here instead of the local bank in town or something.
Instead of something that's like if you own a grocery store shopping at someone else's grocery store.
Exactly. It's almost like stealing from yourself.
Yep. Yep.
Okay. Anything else? Are you ready to start covering this?
I think, yeah, we can jump in.
Okay. So illustration 1, Nelson shows us paying $40,000 in over 4 years. And if you go to the very top of page 54, he has it broken down to showing the premium and where it's allocated, okay? It says $14,999.99. That's the base premium of this policy. And then it says paid up additions rider $25,000. So he has 2 pieces to this policy. Kyle and I have mentioned that you can also have term insurance with policies. Nelson hasn't done this in these.
Yep.
Okay. So those 2 combined equal to $40,000 of premium. And if you go down into the chart now, you can see that after 4 years, no more premium is paid. You can see that in the net annual outlay column. It's column 3 from the left. Now, what is happening? How is this policy funding itself, okay? What happened was he did a premium offset. And if you go over to the death benefit column and look at, he has it highlighted in black. At line 4, there's $1.684787 million of death benefit. The next line, line 5, there's $1.651077 of death benefit. Okay, you're wondering, why has the death benefit gone down now? What Nelson has done is he has quit paying the $25,000 paid-up addition rider, and he's only paying the base premium now. So what's happening is there's a dividend of $6,339 being paid in the 5th year.
Mm-hmm.
That isn't enough to cover the $15,000 base premium yet. So Nelson sacrificed paid up additional life insurance that the paid up additions rider created to cover the remaining, let's see, that's probably about $8,700 or so dollars to cover the $15,000 premium.
Yep.
Now, you'll see that the death benefit continues to drop until
Year 17.
year 17.
That's where the dividends are big enough to pay the full base premium there.
Yes. And he no longer has to sacrifice paid up additional life insurance to pay for the base premium because the dividend is big enough to cover that.
Yeah. And this is not how we would typically structure a policy, but he did this for learning purposes.
Absolutely. These things can be run a million different ways. They can be designed a million different ways. This is just meant to be an example of how you can do this. I also think that Nelson probably, I never heard this from him, but I suspect that he wanted to show that you don't have to physically pay for whole life insurance for your whole life.
Yep. Yeah.
Okay.
Yep. That's
demonstrating a short payment schedule just to show like this isn't what everybody thinks it is. Whole life insurance, I have to pay premium my whole life.
Yeah. And we should also probably note that the first 5 illustration examples in here, these are based off the 2000 dividend scales. So they're more in a much higher interest rate environment than we are now. So these numbers are not
Current.
Yeah, they're not current, but we're still able to achieve the same thing in the same manner.
Right. We can still do the same funding options. We can still do the same type of banking or financing like what Nelson describes in this. The dividend rates have just come down. Interest rates have come down.
Yeah, and
That's all.
like we said earlier, that how you fund it is much more important than the dividend rate that you receive.
Interest rates are going to be up. They're going to be down. You and I can't control them.
Nope.
The life insurance companies can't control them. All we can control is our actions. Our job is to, with this policy, is to pay the premium on it, right, Kyle?
Yep.
We can control that. And that is the most important thing that you can do.
Mm-hmm.
If you want similar results to this, as Nelson says later in the book in the addendum, just capitalize the system for another year.
Yeah.
Okay? It takes more in a lower interest rate environment to do that, but you can still use the policy for all the banking qualities.
Absolutely.
Okay. So that's an explanation of why death benefit's going down, how he's paying the premium. And then you can see that Nelson is showing an income being drawn at age 66 of $92,000. And what he's doing is he's just withdrawing money here. He is not doing this with withdrawals and loans. This is just withdrawing money. So this becomes taxable at the point that he withdraws more than he's paid into the policy,
Which is $160,000.
Yes. So in year 2, he already has taxable income from this policy.
Yep.
Okay. But you can see, even doing that, he had $2.406 million in death benefit when he started taking income from this policy. He ends up with $2.407 million when Nelson kills him at age 85, it looks like.
Yeah. So, I mean, that's withdrawing a lot of income there.
A lot of income, yes. Okay. Anything else we need to cover on this illustration, Kyle?
I don't think so.
Okay. Let's move on to illustration 2. This is where people get confused. They're like, holy cow, there's magic in policy loans. That is not the case, and we're going to explain why that is now.
Yep.
Okay. So Nelson talks about a logging business, and so he's starting to finance a truck with this policy. Nelson goes on to say that 27 cents out of every dollar paid when he was using an outside finance company, not using his own bank, that was interest. Okay? So when Nelson went into these illustrations, he was accounting for paying extra interest to the policy. That extra interest is premium payments. Now, how Nelson did this was he took this policy, he designed it the same as the first one that we just went over. But in year 5, he shows a loan being taken of $52,600. But he writes $34,600 there. That's because he didn't want to add more columns to this. He just took the $18,000 payment out that he was already going to make and simplified it.
Yep.
Okay. How did he come up with the $18,000? Because the outside finance company was, I believe it was $1,502 per month that he had to pay them.
Mm-hmm.
So $1,500 times 12 is $18,000.
Yep.
That's where the $18,000 number comes from, okay? Now, to explain exactly how this is working, Nelson is taking a loan for that truck from the life insurance policy. What he's doing is that $18,000 is being used to pay down the principal of that loan. The life insurance policy itself is paying for the interest on that loan.
Mm-hmm.
The money that is paid in over the principal goes toward premium payments to the policy.
Yes.
Now, how you can see that that's what's going on, if you go over to the cumulative net outlay column, you can see at the end of year 4, there's $160,000 cumulative net outlay. If you go to line 8, you can see that there's $179,400 cumulative net outlay. That's a difference of $19,400. If you go back to page 52, Nelson tells us that $19,496 on every truck was an interest. Okay? So he just went with a round number, went down to $19,400 for simplicity.
Yep.
Okay? That's exactly what he's doing. Now, that $19,400, that's extra premium, extra interest, but that really is just premium payments that's going into the life insurance policy.
Yeah, so people get hung up on this. So how this policy is set up, it's not a max funded policy. So we're not up to the MEC limit here. So that's how he's able to add in extra interest. People, we set up policies and stuff, and they look at, well, where can I put my extra interest in? Well, if we've set up a max funded policy, there is no room for extra interest.
And that's an instance where Kyle and I will say, if you want to pay extra interest, use like a savings account or some type of account at a bank, a traditional bank, not the bank that you've created, and start accumulating money there. Once you have enough money accumulated, then we can start another policy.
Yeah.
The other option is you can build in extra room to your first policy if that's how you want to be an honest banker.
Yep, that is totally a personal decision.
Absolutely. Totally a personal decision. Okay. To get back to illustration number 2, if I want you guys to go back to illustration 1 in the book, you can see that the cumulative net outlay for that policy was $160,000 because he paid the $40,000 in for 4 years and he didn't add a dime after that. Now, if you go to illustration 2, go down to line age 65. You can see the cumulative net outlay is $315,200.
Mm-hmm.
That's a lot more than $160,000, isn't it, Kyle?
Yep.
That is why there is more cash value in this policy. That is why he can take more income out of this policy. That is why the death benefit is bigger. All of these things are because he paid more premium into the policy.
So him being an honest banker and paying in this extra premium led him to be able to take out more money in passive income phase. He's able to take out $100,000 at year 66, and then from year 67 to 84, $125,000 a year.
Right. His being honest was the direct, what caused the direct result of this. His willingness to pay premium, his willingness to be an honest banker with himself.
Yeah.
Okay. That's illustration 2. You guys can apply these same things to the other illustrations in here and see exactly what Nelson is doing. That's exactly what is going on in these illustrations. I think Kyle and I should go on because everybody's thinking, we're in this low interest rate environment. I can get access to money between 3, 4, 5, 6% from outside sources. How does it make sense to be an honest banker, with this?
Mm-hmm.
Because in Nelson's illustrations, the interest rate with the life insurance company was 8%. The outside interest rate from the truck finance company was about 16.4%. Okay. Easy to draw the lines there, right?
Yep.
How do we do it now?
How do we do it now?
Yeah.
This still makes sense because it is becoming your own banker. So when you become your own banker, you are in control of your capital. So you can decide, well, I want to borrow from my personal banking system, or I want to borrow from a third-party lender. It's up to you. Or maybe I want to use my cash values as collateral at a credit union and maybe get even a lower interest rate than I can at anywhere else.
And then what should you do to be honest with yourself? Okay, say you get a lower rate at an outside banking system. Say you get a 3% loan and say your policy was going to charge you 5%. Pay that extra 2% back to your system.
Yeah.
Because if you used your system, you would have had to pay it anyways. Be honest with yourself.
Exactly. So, and that's kind of where we get back to valuing your capital the same as you would anybody else's.
Absolutely. And not stealing.
Yeah. So if you use a bank, let's say Wells Fargo, like they do not care about you. They just want, your interest. They just want to make money off you. That's how it is. Your own money. That's you care about yourself more than anybody. So you should care about your money, your system more than anybody else's.
If you're going to pay Wells Fargo back at, we'll just say 3% or 5%, whatever it is, if you're willing to pay them money pay them interest to use their money, you should be willing to pay yourself at least that much interest back to your own system.
Yeah. It's hard to argue against that once you see it in that light.
This comes back to the whole opportunity cost thing where people they want to pay cash for things.
Yep.
But if you're willing to do that with somebody else, pay them interest to use their capital, you have to be willing to do that with your own system. You don't realize or think about a lot of times that you're losing that opportunity to earn interest, but it's there. Yeah. You just don't feel it. You don't see it.
You don't feel it and you don't see it because you're used to the typical savings account, which is 0.01% interest, which is nothing, but there's other ways. So.
And you've never been taught to think this way.
Yep.
You've never been taught to value your capital.
It's crazy talk. Yeah.
Yeah. Cash is always, what's the word I'm thinking of here, Kyle?
King?
Well, I guess I was thinking like a lot of people, like they don't value their cash very much, it's about assets and things like that. Mm-hmm. But really, like, cash is important. Cash is king. You can't do things without it, but people don't think this way.
Yeah.
So.
And having cash flow and a cash flow strategy, I think is way more important than paying cash and investing.
Absolutely. This is foundational to everything else that you're going to do in your finances. Investing should come after this.
Mm-hmm.
You can absolutely use this policy to invest, but this is foundational. These are things that you need to, if you're in your 20s, 30s, 40s, 50s, these are things that you can be doing now, learning about this and implementing these. But these are things like you should be teaching this to your kids and instilling this type of mindset in them as well, because this is so important and will get them so much further than any type of investing it is going to do in their lives.
And the whole life insurance just happens to be one of the best tools for building generational wealth.
It's unbelievably simple. How easy this is to do. I mean,
See, we're not just accomplishing becoming your own banker. We're accomplishing so many other things.
legacy planning, it's unreal. I mean, it's hard to even list out everything because the more you think about it, there's more things that you're doing with this system.
Exactly.
So, I hope that helps you guys through the illustrations. I know we didn't cover them all, but Kyle and I just felt that would be really redundant. We'd be talking about a lot of numbers.
So reach out to us, though, if you have questions about the other illustrations. We'll be glad to help you through it.
Exactly. But we did explain exactly what's going on in those two illustrations. So hopefully that gives you everything you need to get through the rest of them.
Yes.
So, okay. I have said everything I want to say, Kyle.
Yep. I think we got this one covered.
Okay. See you guys next week.
This was the Cash Value Solutions Podcast. Remember to subscribe, rate, and review the show. Check us out at cashvaluesolutions.com. And don't forget to tune in next week.